Ignite your curiosity with Austin Next. We're watching Austin transform from a thriving ecosystem into a global superstar. With our host, Jason Scharf, we aspire to better comprehend the true nature of innovation. Together, we will uncover what makes a successful ecosystem and navigate the technologies shaping our future. Now let's dive into what's next.
Today's podcast is sponsored by Austin Private Wealth, a registered investment advisor focused on fee-only financial planning and investment management. Their mission is to serve affluent clients with personalized financial advice, fostering a trusted relationship that will endure for generations to come. Austin Private Wealth is not just about managing wealth. They're about inspiring you to embrace a future filled with possibilities and helping you architect enduring legacies. Their core values of integrity, service, caring, excellence, and growth are at the heart of everything they do. Connect with them today at austinprivatewealth.com.
Austin Private Wealth is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Austin Private Wealth and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Austin Private Wealth unless a client service agreement is in place. Investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
A few weeks ago, I saw a viral tweet that set off quite a bit of controversy on the health and scale of the Austin pre-seed and seed environment. I thought the best way to answer this question is to bring on two local VCs who are directly focused on this stage. I am joined by Katelyn Donnelly, managing partner of Avalanche VC, and Rajiv Bala, general partner of Clutch VC. We discuss how we define the stages, the evolution of the Austin market, and what trends they saw this year and heading into next. I hope you enjoy our discussion.
Katelyn, Rajiv, welcome to Austin Next.
Thanks for having us.
Excited to be here.
I'm excited to kind of see where this goes and dive into really what is going on in the earliest stages of the VC market and startup market here in Austin. I think a good place to start with here is just why don't we talk about each of your firms, what you guys are doing, what stage, and kind of what your big themes are. So Katelyn, you want to start us off?
Sure. So my fund's called Avalanche VC, and we invest in the first institutional round of capital into companies that are transforming how people learn, earn, and own. So that often means like edtech, future of work, SaaS for small businesses, companies that might be connected to home ownership or owning your own data, that sort of thing. And we want to be, super early, right after your angels' first institutional round.
And we are Clutch VC. We are a pre-seed and seed stage fund focused on Texas. We also want to be first institutional money in. That can be a participation in an angel type of round, or our core check is really $500,000 into $1 million to $2 million pre-seed round. We are focused on Texas B2B software businesses, and we try to bring a bunch of resources to the table at the early stages to help our companies.
So I like the fact that both of you said, okay, first institutionalized check, but sometimes an angel round, a pre-seed and seed. So there's a lot of, I think it's gotten really muddled on what we kind of mean like pre-A, angel, pre-seed, seed. How do you define these stages? And would you be using is it size of round? It's the valuation. What's the metrics to say it's an angel round, it's a pre-seed, it's a seed?
I can hop in. So the way that we think about it is we call it the angel or incubation round. That's usually pre-product, definitely pre-revenue. Round size tends to be about $250K to $500K. And then once product is built, maybe it's an MVP, maybe it's something more than that. Usually early revenue or an unpaid pilot or something like that. That's what we call the pre-seed round, 1 to 2 million. And then kind of after that, at least what we're seeing in the market today is the true seed rounds are happening that are typically around $3 to $5 million when a company is $500K to $1.5 million of ARR. And then, Series A is beyond that. Where it's right now, it seems like the markets are frozen, but when they start opening up again, we think it's going to be in the 2 to 5 million of ARR, $8 to $10 million type of rounds.
Put a pin. I want to come back to that comment of the markets are frozen. I think it's an interesting comment, but I want to dig into it. Do you have the same definition?
Yeah, I do. I think I would say pre-seeds are less than 10 million post-monies generally. and maybe seeds at max 20 million post money, but more like 12 to 15. And then each round should probably be for like 12 to 18 months worth of runway to hit the KPIs for the next round. Or even in some cases, we are pushing our founders to get to cash flow break even and make it more optional. But we can talk about that later.
Well, so then that's a question because, so it's not being driven necessarily, so it's being driven by size of check and size of valuation rather than what level of money it's in. So I'm thinking like, I just want to take an edge case for a second. Somebody, multi-time founder and goes in and says, okay, I'm raising a 20 million post money round. We then just going to call it seed, even though that might be the first check in.
I think some people have been doing that. And that definitely happened in 2021. You do have like a $3.5-4 million seed, like pre-seed seed round on 20 million post. I think that people are reflecting on that and saying maybe that wasn't smart or a good idea for either the founders or the investors.
Yeah, the way that these rounds get announced, it's the incentives are a little bit weird because, is it better for me to say I raised a small A or like a really big seed? And what you typically see is people saying I raised a really big seed.
It's also been interesting to see some of the gamesmanship on whether you're even announcing some of these, like a deal that I was in. They announced when they announced their A, then they announced kind of, oh, by the way, we'd raised X amount pre-A. Like that was the entire announcement. And I know from the being in, I was like, yeah, there was 3 small rounds as they kind of gained the traction, and then they had a really good, a really big A. And so it was an interesting thing. Like, we're just going to lump it all together. We raised money, and we want you to kind of focus on the next step.
Yeah, I don't think the journey, once you raise an A, I don't think and price the round, I don't think the journey to get there is particularly important to anybody other than, people on the cap table.
And do you see any differences between these rounds in terms of the vehicle, whether we're talking about convertible, priced, safe? Does it depend, and do you see more of one at the other at different stages?
I exclusively do safes with the expectation that they'll convert in, 18 to 24 months. I mean, I would do price rounds, but we tend to just be earlier than that. So it doesn't necessarily make sense.
Yeah, we're happy to do either, but usually if you're raising less than $2 million, it doesn't really make sense to spend 40 or 50K on a priced round on just legal fees. And so usually if it's over 2 million, we tend to price it. If it's below that, we tend to do a safe, but nothing's hard and fast for us.
So let's jump to Austin and the state of the environment here. So the origin of this episode was that there was a viral tweet, a few weeks ago that said Austin desperately needs another real pre-seed fund. And there was quite a bit of pushback in terms of, well, these exist, these don't. I will say some of the list I saw, people were like, these exist. I'm like, they don't really do seed. And so I want to start, Katelyn, with you as the relative newcomer to this. And I'm still going to claim newcomer status, even though it's been almost 3 years. How would you describe the state of pre-seed and seed in Austin?
I think it's varied is the reality. Like you have a lot of, I've met a lot of solo GPs or small firms, sort of like me, that have a vertical focus. And then you just have a lot of also like Austin angels around Austin that might do a whole wide range of things. And then I think what the like perceived lack comes from, there's no like one Austin pre-seed fund that's like, I just look at everything that's in this like Austin ecosystem that isn't one of those funds that's been around for a long time, that's now gotten bigger and is really doing seeds and mostly A's. My contrast to this would be, I was in halftime in Seattle before I moved to Austin, and there are definitely quite a few funds in the Pacific Northwest that just invest in the Pacific Northwest ecosystem at the earliest stage. And so you can go and talk to all of those funds and those fund managers if you're a founder. First, I think it's a little bit harder to navigate for founders in Austin when you have a bunch of like vertically focused pre-seed funds and then no like dedicated Austin generalists.
So the ones in the Pacific Northwest, I think obviously we're thinking like the Seattle type of ecosystem. Is it that those dedicated pre-seed funds are really generalists, or are they not, they have just a few verticals? Like how are we to think about them?
Well, Seattle is very obviously enterprise tech focused and now AI oriented. And so I guess you could say they're not true generalists, but like they're definitely more generalist than say I am, right? Like they'll look at kind of everything, and because the ecosystem breeds a certain type of company, they can match the funds, and the companies can match, I think, pretty well. Versus I think Austin just has so like the diversity of what people are building here is so all over the map. Like you have actually quite a big ed tech ecosystem. You also have a big like space tech ecosystem, and then you have B2B SaaS. And so you have so much variety here in Austin.
Doesn't that then, while being harder to find, lead that we would want more dedicated vertical funds rather than overarching general?
Yeah, I mean, I don't think that there's a problem with it, but I'm not a founder, trying to raise my first round, so I'm cognizant of that.
Rajiv, you've been here a while and kind of seen the ecosystem. Walk me through like the evolution of this stage. Is it different now than it used to be? How would you kind of layer in what we're talking about at this stage?
Yeah, I would go back quite a bit to kind of give you the history of how Texas has evolved. But if you go back to, the 70s,
Oh, we're
80s,
going way
not
back now.
much here. Yeah. And then you start to see some telecom or semiconductor firms primarily start to grow in the venture ecosystem. And then those grew telecom companies. A lot of that telecom and semiconductor activity was focused in Dallas. And then a lot of those telecom and semiconductor companies started to put their software divisions in Austin. So some of the big enterprise software wins were spinouts of those software divisions. A lot of the venture capital activity was really focused on Dallas up until the dot-com crash. And then after the dot-com crash, you had Austin Ventures, which had done very well through investing in enterprise software companies in the late 90s here. A lot of the Dallas firms that were focused on telecom and semiconductor got wiped out. And so Austin Ventures in the early 2000s ended up raising some pretty massive funds and then started to drift later stage. That was when what you would think of as the typical incumbents now who are in Austin, that's when we all started in, between 2005 and 2010 with small funds and filling in the gap of what you would now call pre-seed. And, those firms have all had tremendous success and have raised bigger and bigger funds. And now, I think Mike Maples has a great quote about how your fund size dictates your strategy. And so what you're seeing is a bunch of these firms that have raised funds between 200 and 350 million. They're going to have to naturally drift later stage. And so that drifting early stage has, in my opinion, created a massive vacuum at the earliest stages. So I would say we're undercapitalized. We need a lot more firms like us and like Avalanche that are writing checks, high conviction first check type of firms. And that's ultimately why I started this firm is, this kind of pendulum continues to swing back and forth. And right now there's a lack of capital, and we really wanted to serve Texas entrepreneurs in that kind of first check way. So hopefully, as we get out there more and, we are going to be we are a dedicated Texas focused first check investor. And that's a role that we desperately want to play in this ecosystem.
So when we think about this stage, we've got a couple of different types of groups. We've kind of mentioned them all here, right? You've got the angels and the angel groups. You've got accelerators, things like the two of you guys, the 1-2 GP small funds. And then you brought up, Mike Maples, like you have then firms like Floodgate that are larger than that, but then highly dedicated in this particular vertical, or at least this is the stage. How do you think about each of those groups, and do they play a different role in this stage? And should founders be thinking about them differently when going to a established firm, an accelerator, or like an angel group versus a 1-2 person GP fund?
Yeah, I think that there's the way that this ecosystem in Austin has evolved. There's on kind of the angel group side, there's, I would say, very few folks, kind of like Brett Hurd, who I think you've had on this show, who are programmatically and consistently writing angel checks. What I'm seeing right now with companies that are coming to us for a pre-seed round is that the angel capital that they've raised is often from domain experts that are not prolifically writing angel checks. So that's, I would say, the first way that entrepreneurs should approach kind of the angel networks and individual angels. On the accelerators, incubators, there's, I think, 20. Last I checked, there were 22 different incubators and accelerators in Austin.
Really? I can think of like 5.
Yeah.
So I'm missing obviously like, a whole bunch.
There's a couple that have shut down in the past,
Sure.
a couple of years, but it's still very active on that side, and you can find vertically specific accelerators, incubators, all that type of stuff. So I would say, especially if you want access to really interesting industry folks, or if you don't have the access to investors, those are great places to go to. And then, 1 or 2 GP firms like our firms, I think hopefully we are pretty approachable. We want to meet people as early as possible, pre-company even. We like to track folks. We like to maybe even, engage in those angel rounds, that type of thing. And then all of the rounds that we put together, we are bringing in co-investors, and we certainly want to have a number of syndicate partners with us on rounds. And so those bigger seed stage funds often are doing both pre-seed and seed. So we like to typically have one of those in the rounds that we put together so that we have some built-in follow-on capital for when the next round is ready.
Katelyn, I actually want to start kind of again from your experience outside of Austin. We talked about these programmatic angels, and are you seeing? I kind of think of it as almost like 3 flavors of angels. There's the structured angel groups and associations, which a lot of times have certain, to be frank, they're slow. That's probably the biggest. They have capital, but they're very slow. You have the as you mentioned, like the Brett Hertz of the world, who are the super angels. I can just go I'm going to do myself and write those checks. And then you have kind of the the term I've used before is like the free agent angels, where it's kind of people floating around. It's actually the group that I put myself in, right? It's people kind of floating around, would like to be part of structure. And usually it comes back to like, oh, well, so-and-so has a deal that's interesting. Oh, okay, 5 of us got together and having a conversation and kind of doing the due diligence ourselves. How would you compare that with like, the Pacific Northwest and these other ecosystems that you've been? Is it similar? Do you have a lot more in one direction or the other?
I'd say that there's people, particularly like in ed tech or future of work, who write a lot of angel checks, and it's not geography agnostic. And so I often like collaborate with those people. And the angel checks that I look for companies that I like to back are when people can get angel money from their friends and family, from former employers, from their customers, from people who are showing a lot of belief in both the idea and in the founder, because they have an information advantage on them. I'm less interested, or I think there's just less signal in the sort of like, I went to a pitch day and they were blown away, but they were blown away by the pitch. And I feel like those are kind of going away. And people I think Seattle has some parallels with Austin in the respect that, maybe it's even worse in Seattle, where there's a lot of corporate people. And when they do angel invest, they can sometimes expect a lot of protections or like convertible notes and more ownership than really what makes sense if you're really going for a venture-backed company. And I think that can be one of the sort of kisses of death for a company early, because it's such a negative signal to bigger firms, particularly in Silicon Valley and New York. And I think that, at least for me as a vertically specific focused fund, my biggest successes have come from when a tier 1 or tier 2, the tier 1 investor has led the seed or a strong Series A into a company that I found at the pre-seed. And if they're taking angel money or incubator money with high ownership and little, advice, help, links to customers early, you're just not set up for success.
How do you think about the incubators and accelerators? First, just generally, should be people approaching them? How much value can they add? Obviously,
I know the answer is it depends. There was actually a list by CB Insights literally came out like today or yesterday that was like, here's the top, accelerators. And it was, the ones you've all heard of. Number one was YC. Number two was Plug and Play. And so it's the types of things that you would expect to happen. But how is you approaching companies that are hitting accelerators or incubators? And obviously they're different things from that perspective.
I'll say something that maybe a little controversial is like, I prefer companies that haven't gone through incubators. I think that many of the incubators take a lot of ownership, and then they might not have like lasting mentoring relationships that last that long. And I think the startup game, at least what has been played over the last 10 years, there's now very like playbook. It's like there's a playbook, it's tried and true. There's a lot of resources out there. There's a lot of people that have been through it. And I don't think you need to go specifically to an incubator to get those things. And if you do, then it's maybe not like the best sign for founder quality. I mean, you can pick through it and maybe find some gems, but the reality is like this is a very competitive game that we're playing, and you want people who are stacked for success. And those tend to be people who already understand the game and are, have been at a high growth early stage company before that's had a good outcome, or they're on their second company because they've learned what has happened in the previous one and they don't need to kind of go through the training wheel phase.
One of the problems I've seen a lot with, especially on the accelerator side, is there are people who aim for accelerators as that in and of itself is the milestone. And I think when you're thinking about an accelerator, is I should be accelerated by the time I get out. So what steps is it going to allow me to jump versus I've just seen, somebody been like, I got into this accelerator and now I'm going to go to this place. And I'm like, okay, at what point are you growing up?
So that's a good point, because this is this other thing I also look for. And I also see that for, by the way, in seeds and series A's, is you're like, for what purpose? Like, are you going through the accelerator, or are you raising from that fund because it's a credential, because you're playing a status game so that you can be X founder or whatever? Or are you doing it because it's going to drive an outcome for your company and for your investors? Because there's sometimes, even with founders that are, nearly cash flow break even or have a good business, you're like, well, why would you raise this big series A from this firm or take these terms or whatever? And sometimes when you talk to founders, it's like, well, I really just want to be like a tier 1 back venture founder. And you're like, okay, well, that like you're
You're playing the wrong game.
Sometimes it feels like a status game rather than let's like be focused on generating 100x return for the people on the cap table.
Yeah, we used to have this saying at my old firm, like, is the capital going to accelerate progress or is it going to delay it? And you, as an investor, do not want to invest in a company where it's going to delay progress. You want it to go into company acceleration. And so, to your point, if an accelerator is going to do that, then it can be a really great thing. Of our 7 portfolio companies today, 2 of them went through accelerators. And so we will absolutely dig into the accelerator programs. But to Katelyn's point, most second-time entrepreneurs, been there, done that folks, go directly to the source.
Sure. And if you get access to the second time, always the question is, how do we pick out the diamonds that are in the first time, right? Which is I think, in theory, one of the values of the accelerator is you've got that additional, social capital, but they got to be going into it for the right reason and not just, I mean, as you even said, like if you create 100x for somebody, that'll create enough, status right there that I don't think you need the outside status to kind of move you forward.
Well, I think of accelerators like education, like school. So I'm in the education space, right? And we have a mantra that we don't invest in schools. Why? Because schools have negative economics of scale, which means as you get bigger, every additional student that you have in is likely less prepared and less likely to be able to pay full ticket price. And so as the accelerator market has like boomed, you've had the same negative economies of scale where your average startup founder is, less prepared and less likely to be successful going in. And there's only so much like any education program can do in 3 months to like move a needle.
I think it's what we're seeing, both the scaling back of accelerators that have gone under, and then also ones that have like shrunk in size. I mean, I kind of joked at the little of the Groucho Marx, but I knew that YC about 6 or 9 months before they kind of did their whole culling down and shrinking the size was probably heading in that direction because the number of YC companies that were coming across my desk. And I'm like, no. I shouldn't be having access to these. If I'm getting access, there's a problem.
Yeah, or you're getting access at like a crazy valuation, right?
Right.
Yes. So from that, then, if you look at kind of back to the question on the tweet itself, if we look at, angel groups, accelerators, more of these small vertical funds like yourselves, or, a floodgate type of situation, what would you say? Because Rajiv, you said there was a gap because a lot of those funds had kind of moved up as they got larger, which is not unexpected. What's the answer? Which one of these do we really need or are missing?
Yeah, in my opinion, so pre-seed and seed is the most inefficient part of the capital markets, right? In my opinion, you got to be close to your companies, whether that's physically or sector focus or something like that, to be able to really help your companies get to the next level. So what you find is that capital traveling across geographic boundaries tends to be harder at the pre-seed stage. Traveling from a vertical fund to a different vertical is virtually impossible. And so, one, I think we do need more capital at the pre-seed stages here in Austin. And I think that's going to solve itself over time. The capital goes to where is the opportunity. And we have, as Katelyn said, a number of pre-seed solo GPs and, early fund managers that have moved here in the past few years. And there's just a tremendous opportunity in this market. So I think it's going to be solved. But as a community, that's where I think we should be focusing, is trying to get more. It's not just more capital into pre-seed in Austin. It's more fund managers, because also in the pre-seed, these tend to be non-consensus deals, high conviction, and you're wrong a lot, and there's many different reasons to be wrong on a lot of these companies. So we just have to have a lot of different viewpoints, a lot of diverse managers, you name it. I think we just need more managers at the pre-seed level.
I totally agree with that, and I also think that it's a manager intensive time. So like when you have a pre-seed company, like and if you're really stewarding it as a pre-seed fund, you're spending a lot of time with those founders, and you have a lot of skin in the game because most people are on their first or second time fund, so they really need to succeed, and so the incentives are really aligned to perform well. But it's both time and money that people are putting in.
So we've heard a lot about some of the market situation right now, and I think that both of you saying that we need more managers, and I know it's really hard to be an emerging manager right now. The markets, and especially LPs, have gotten very kind of skittish. So I think it's a good way to kind of shift the focus a little bit, so that as founders are thinking about trying to raise from pre-seed and seed, to give them a little glimpse of what the other side of the table looks like and what you guys are doing. So I think I just want to start off with, the actual mechanics of investing at this stage. And Katelyn, I'll start off with you. How are you thinking about portfolio construction, and how is that probably different than, say, a Series A targeted fund is looking at it?
Yeah. I'm a bit different because despite being pre-seed and seed, I feel like I'm a high conviction investor, and some funds in my stage would have like 35, 40 positions, really diversified, because if you look at all the portfolio math, usually you need about 40 to sometimes 50 positions in order to hit a real outlier or a unicorn. My bet is that as a specialist, my hit rate will hopefully be higher for the companies that I've spent a lot of time in. And that was my lesson from my fund one, is the companies that I, incubated early, that I got to know the founders over like 6 months before they even incorporated the company and I really worked with closely, have done super well. And the ones where I was just kind of joining around has been a little bit more like hit or miss. And the type of investor I want to be is more high conviction, like working deeply with founders and helping to get them to the next stage. So my portfolio construction is a little bit more concentrated, but it also means that it's that I'm going to see thousands of companies and say no to almost everything. And so that's the other, I think the hardest thing about this job is that you meet amazing people, and founders are so smart and visionary, and there's so many things going for them, but it just might not be like a you deal for this fund and for the thing that you need to prove to your LPs. And so there's a lot of reasons like why company might not be a fit for me. But that's, to Rajiv's point, like why you need a diversity of capital and fund managers in the city, and you need those like small GPs to work together so that they can pass deals off to the right people and be like, hey, I met this really awesome founder. It's not, doesn't fit into one of my thematic verticals, but maybe it'd be great for you. And that just like reduces the friction time for founders who don't have to go and try and find all these like new solo GPs. They can, get sort of like quasi warm intros.
So how do you think about then, if you said the ones that you've known for 6 months and longer? I think one of the hardest things, and I tell this to a lot of founders, is, I mean, it's almost the same thing as like when looking for a job. The first time you meet somebody shouldn't be when you're asking them for something. It's like, hi, I know you can give me money, or hi, I know you can, I've just met you, give me a job. So how do you think about that kind of building that relationship, especially since we're talking about the earliest stage? When should they start to connect with you? When should they start meeting to really set up the right relationship? Since I'm guessing it's not of 10 seconds after they're pitching you, or 10 seconds before they're pitching you.
I think that's a hard one to answer, because no, founders are not commodities. They're not all the same. And when I end up digging in and spending a lot of time with a founder before I know I'm going to invest, it's usually because I'm like, oh, I really believe, like, we have a shared vision of the world of where a very specific like part of the market could change. And you have been working on that for like 10 to 15 years, and you're not quite ready to like raise the money yet for your idea, but we're very aligned on your ability to execute on it and the fact that this is an exciting opportunity. But if one of those two things isn't true, which is 99% of the time, like I don't want to continue engaging because it's probably just never going to be a fit for me.
Yeah. Across my venture career over the past 16 years or so, average time from first meeting to closing an investment is 6 months. The longest time was 4 years, and the shortest time was 2 to 3 months. So we are almost never participating in a high pressure situation. We're closing next week. Do you want to throw in some capital? We like to meet people early, like I said, even before they're founding the company. And we're actually launching some initiatives around company formation and bringing that community of founders who are interested in founding companies, maybe working on a new idea, maybe don't even have an idea yet. We are going to try to invest a little bit more in that in Austin over the next couple of years, because I think there's a lot of really interesting talent out there that's ready to start their company.
And I've had this discussion with others, when you think about the talent side, because we don't have quite as many cycles as other ecosystems, it's hard to always say, well, I want to find somebody who has that exit already or was at, number 10 at this company. So how are you thinking about identifying either early talent or early founders when there aren't the signals that are as readily apparent?
Yeah, for us, we've been investing in Austin for a long time. Me for about 16 years, my partner for over 30. So we have some pretty deep networks of founders, venture-backed executives that we really rely on for folks that have been in Austin for a while. As you know, we also have a ton of people that have
I was
moved
going to
here
say,
in
yeah.
the past little bit. And often we are finding ourselves looking at, for people who've come in, they have relationships with seed funds in their geographies that they emigrated from. And so, we've looked at a couple of deals recently where there's a lead in place of a person from New York or LA or Chicago, but they want a local person to integrate them into the ecosystem. And so that's where we try to play that role, is joining syndicates where we can really add value on bringing the Austin and Houston and Dallas networks to these companies.
What do you think about the LP side of the equation? So the LPs for pre-seed and seed funds, I would assume are quite different than the A and B, just given relative check size. You're probably not raising from large endowments or pension funds, unless I'm wrong. So, what are you hearing and seeing from LPs at this stage, and who are they?
I'm happy to jump in. So our LP mix is we've got a number of GPs at later stage funds. We've got a number of high net worth, folks that we've worked with in the past or successful entrepreneurs in Austin, Houston, Dallas. We've got a lot of family offices and a little bit of fund to funds. So we're in general seeing a trend of more institutional capital coming towards fund to funds. I think that's going to be a big source of capital for funds like ours over the next decade. But usually on fund ones, the source of capital is high net worths and family office. And in Texas, that there has not historically been an appetite with a lot of oil and gas families to invest in venture. And I think that's changing now, which is great to see. So I think we're going to see, a lot of these small seed funds get off the ground with family office capital. And I think we're going to see a bigger movement of Texas family offices into the asset class. And that'll likely be into small funds like ours. So we're pretty excited about that in general.
Are we seeing the LP market for Texas? Like, how does Austin compare? Is it really kind of across the board? Are you needed to go more to Houston and Dallas? Like, what are we thinking about the family office and high net worth scene?
Our experience is that people in Austin, a lot of the source of wealth is venture-backed companies in Austin, in addition to oil and gas, real estate, all of that type of stuff. And so we tend to see more family offices interested in the asset class in general in Austin, and then Houston, Dallas, San Antonio. There's actually way more capital, but it's less interested in the asset class. So we find ourselves doing a lot of education in Houston, Dallas, San Antonio. But there even in kind of the past couple of years of fundraising, I feel like the interest in venture has dramatically improved.
Katelyn, I mean, talk a little bit about some of your experience with the LP side, especially given you changed markets and you moved to Austin. How's that kind of affected the story, maybe positively or negatively?
Yeah, I mean, have a probably similar mix of LPs, like family offices, some fund to funds, strategics in my case, high net worth individuals. I was thinking about this because I saw it in your interview guide. I actually don't have a single Texas LP right now. I mean, part of fundraising on we were talking about how it takes 6 months from meeting a founder to investing in a company. Well, I think to get an LP, it takes like at least 12 months minimum, maybe longer. Like people really want to know you over time. They want to partner with you. And it's a long-term game, a really long relationship, at least 10 years. I mean, in a pre-seed fund, like half your portfolio could fail and go out of business. But if you're investing in a manager, like that's at least 10 years, if not more, and you really have to trust them. So at least for me, it's still like the beginning of the beginning for me to develop some of those relationships. But I just love the independent spirit here in Texas and in Austin. And I think people have a real interest in building the future. And then there are a ton of serial entrepreneurs here that have exited their companies recently that are thinking about what's next and want to participate in interesting ways in the ecosystem. So I'm optimistic, but it's still super early days for me.
Yeah, I think it was interesting when you talk about the people wanting to participate, because I was trying to put my finger on looking at the history of Austin, that there seemed to be an inflection point in 2016, 2017. And it wasn't until after finally digging that I realized that there were a bunch of exits that happened around there. And so you had this inflection point because a lot of capital was unlocked, a lot of founders were unlocked. And I think that back to the question about whether the market's cold or not, but I think we might be on the verge. The question is probably not 24, but maybe 25, when some of that happens again in Austin, some of the unlocks. Yeah, I agree with that. They kind of the crossing the finger. So on that, what, Katelyn, I'm going to start with you. What general trends are you seeing in the valuation, money raised, the traction in this stage? And as you've been looking at kind of Austin companies, how do those kind of numbers compare?
Yeah, I think, well, we look so early, and my view is like, you just really need people who are moving pretty fast and are able to be capital efficient quickly. I mean, these are the things I also look for. And what I see that's interesting in Austin is I think you have a lot of potentially second time founders, people who've had a good exit in the last couple of years, who've moved to Austin and are beginning to think about their next thing and are not overly quick to want to raise a venture round, because like they know what that game looks like and they're looking for the right partner and they want to have things that validate it for themselves before they go out and raise money. So I think that's positive. And then you also have so many bootstrapped entrepreneurs here, like people who are running cash flow generating businesses, creator economy type plays. And those might not be venture backable, but it's an interesting part of the ecosystem for sure. And some of them might be able to turn into venture backable businesses, with the right inflection point. So I don't have any like tried and true, metrics for you. I know what we aim for, pre-seeds at like 5 to 6 million posts, for example. I mean, if it's a bigger round, you get up to like 10, but that's kind of like our max is doing a 10 to 12 million post money.
What are you seeing though? We kind of come a lot from, the 21, 22 bubble. And I'm going to put my bias in here because I keep hearing this, okay, it's the worst market in 10 years and all these kind of numbers being thrown out. And then I kind of scratch my head a little bit. And this is where I want you guys to push, because I look at the overall numbers that we seem to be headed towards for 20. So this is the US. It looks like startup money raised will be somewhere between 2019 and 2020 numbers. Austin already, we still got a couple weeks left. I don't know how many things are actually going to be announced, but if we kind of stop where we're at like 3.2, 3.3 billion, which is the third highest year on record, with only 21 and 22, with we all, I think, agree we're overinflated. So this is it's been a really good year if you don't compare it to those, the kind of the crazy years. So I'm not seeing the same thing, but at the same time, I'm not, trying to raise.
I'm just skeptical of some of these numbers because I think people put late stage or very different things that are like not truly venture in that bucket, which create these like big distortions. Like, is OpenAI a startup at an $80 billion valuation with a $1 billion partnership with Microsoft? No, I don't think, like, in what world would you put that in the same bucket as like any company that I'd be investing in? So I think the data is suspect. And then I also know from my own, the data sources, right? There's like PitchBook and Carta and Crunchbase. And I look at the data I have and what I'm feeding into those platforms. And then, so they must be at least like 9 months out of date, AngelList would be like another one, because I know what what their data is on my company, so I assume that it can be similar. And then I think that there's also quite a few things that don't get captured in those headline numbers, like what's the structure, was it debt, was it equity, what was the blended valuation, because I've heard of
portfolio companies versus net new investors.
Yeah,
I think the aggregate numbers tend to favor the later stage stuff. And, in an ecosystem like Austin, where even if you have, because we're up and to the right on almost every metric. And so even if the slope changes a little bit, we're still going to be on this, massive upward trajectory. So it's still, I think if you asked entrepreneurs at Series A, Series B, even beyond that, they'd say it's still frozen. And the from what I'm hearing, talking to later stage investors, is that what we're going to start seeing in Q1, first half of next year, is down rounds, recaps, pay to plays, and basically all the structure on those later stage rounds. If I go back to when I started my career in 2008, everything was frozen for almost all of 2009, and then at the end of 2009, things started to free up a little bit, and then 2010 was all about recaps and structure on rounds and a bunch of the stuff that Katelyn was mentioning. And then we didn't really get back to a normal environment until 2011, and that was when we made one of the best investments of in the history of the firm. And so I think we're going to go through that, and I think that the later stage funds, when it does open up, they're going to start focusing on a little bit later stage deals. So the bar on a Series A is going to go up. And again, this is only if history repeats itself. And so how that affect, if you kind of wind that back to how it affects our portfolio companies and the rounds that we're doing, we are every round that we come into, we are underwriting a plan for 2 years of burn with no new revenue. And whereas a year or two ago, we were looking more like the 12 to 18 months. And so maybe that's overly cautious, but we just want to make sure that these companies are capitalized well enough to be able to withstand the winter if it lasts longer than we expect it to.
Yeah, no, I think everything is being shoved together, right? I mean, one of the reasons that we clearly are doing well like this quarter is that Firefly had the rest of their $300 million round. Now, if you it's good to look apples to apples. On one hand, like I agree on what you're saying with OpenAI, and I know like SpaceX just did another, a tender offer, but like I don't know where the line is, and so at least on the, we kind of keep that going. I think what's interesting is, of course, that those later stages, at least my time being here in Austin, I think that's what started to shift in Austin is we hadn't really had a C and D. Like you had those a little bit, but now that we're starting to have them versus I just remember like we had, I don't know, it was like, I think we were like 600 million or something for the quarter or the quarter so far. And I literally read at that same moment that Boston had like 500 million in 2 weeks. I was like, oh my God, like that's just the difference in scale that we're talking about in some of these things. I do think it was really interesting. I'd love to, and I think Peter Walker from Carta is going to come back on the podcast kind of early next year to give a kind of a retrospective of the whole year. But it is interesting. You talk about like PitchBook and CB Insights versus Carta, and I'd love to look at kind of like an apples to apples of those data because Carta is on actual signed documents and deals versus the other ones are much more on what are we hearing about in the news and what are we hearing about, is coming or what's being submitted. I mean, it's just speaking of like Firefly, when they announced that they're like, oh, we did our third tranche of our 270. When was the second? Like you kind of have to put it on Q4 from just a perspective. But I was like, I don't know, probably happened 4 or 5 months ago, but they didn't announce it. So that kind of makes some of the data a little bit difficult to track and figure out.
Well, even Cartas, you have to remember, like a deal might be basically agreed to or done, but isn't updated in Carta until, it's signed, sealed, delivered. So some of those things just like take a while, especially like I think wind downs too. Companies can zombie for a long time on angel list before they ever really mark them down.
Oh yeah, like if only I had perfect information, that would just make my life so much easier.
Yes, yeah.
So what are kind of your big expectations then, going into for 24 at this stage, outside of, as you said, you're telling them to raise for 2 years just so that they have, runway to get through whenever this market kind of returns to normal?
Well, I push for revenue and cash faster. It's like who's your customer? What can you sell them? How can you get to like cash flow, break even? How many people do you really need to have full time on your core team building out the product before you get product market fit so that you can be cash efficient?
Yeah, efficiency wasn't really the name of the game for a while. And we have a whole generation of entrepreneurs that was not raised on building capital efficient businesses. And so we've definitely seen that. But I'm just really excited about the next few years, because I think generation defining companies are going to be built and they're going to be started next year. And I think Austin is probably, it's got to be on the top of the list of places where these companies are being formed. We've gone through this step function over the past couple of years of people moving here, companies moving here, and that I'm very bullish on Austin for the next decade.
I definitely think one of the things that I found most interesting about people moving here is that I found that so many people are moving here for the generalized allure of Austin and the Austin tech ecosystem. It's not because of this vertical or that vertical in particular, but then some of those are starting to become bigger and bigger. And I just imagine as those narratives start to connect in, we are really strong in biohealth. We are really strong in advanced manufacturing or whatever they may be. And you say, oh, this is the place to go for this particular thing. Then it's going to be a whole new kind of speed at the flywheel is going to go. So I want to end always with the same question. Feel free to answer as narrowly or widely as you want. I'm going to start with you, Rajiv, and then Katelyn, I'll give you the last word. What's next, Austin?
I am just so excited about the opportunity set of the companies that are going to be built here in the next decade. I think the next $10 billion, $100 billion company is going to come out of Austin. We'll check back in 10 years and see if I'm right.
I love it.
I've been using the word Austin scenus, which is a combination of genius plus scene, which is like, I just feel this like momentum of this like collective genius in Austin, which is, mixing and percolating and like coming together for maker weekends and building things and trying things out. And I'm totally with Rajiv. I think there's going to be amazing companies that are coming out of Austin, and they will be started next year and the year after that. And it's such an exciting time to be here. And you really have the space to think big and be long-term and patient and not be distracted by the anxieties of some of the other places. So I'm pumped to be a part of the scenus here in Austin.
I love it. I love the word. I may the Austin scenus. I may start just making that a thing. Katelyn, Rajiv, thank you so much for joining the show.
It was great. Thanks for having us.
Thank you.
So what's next, Austin? We're glad you've joined us on this journey. Please subscribe at your favorite podcast catcher, leave us a review, and let your colleagues know about us. This will help us grow the podcast and continue bringing you unique interviews and insights. Thanks again for listening, and see you soon.